The data is in and it's bad news for several areas within the UK. While some areas are seeing reasonable growth, others are seeing prices stall, sell times double, and landlords exiting the market in record numbers. As an investor, it's not your job to pick the winners. No one knows for sure where the best area to invest in moving forward will be, but it is your job to avoid the losers. Today, I'm revealing our 2026 Red List, which are areas you should avoid if you're looking for capital growth and decent returns in property investment. We're going to look at why London has stagnated for over 10 years now, but we'll also look at other locations that some investors are targeting and why that could be a mistake if you're looking for long-term capital appreciation. If you're new to the channel, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners. I've personally helped hundreds of investors purchase tens of millions of pounds worth of property throughout the UK, but this channel is all about your education. So let's dive right into it and look at 4 locations that you should avoid as a property investor in 2026. The first is an area that I believe should have been on people's lists for a while now, and it's London. We call this the prestige trap. Many investors see central London as a great place to invest in long-term property. However, although there's always going to be a rental demand in central London, prices have stagnated over the last 10 years. While the rest of the UK has seen steady growth in the last few years, London hasn't done anything since 2016. And when you adjust for inflation, London prices have actually dropped over the last 10 years. The main reason for this is the lack of affordability in central London. Residential property always comes back down to supply and demand. If there's a demand there, property prices will continue to increase until affordability prices people out. This is what's happened in central London. Property prices grew because demand was really high. Prices got to a point in which the average people or the average couple in this area could no longer afford to purchase these properties. This meant that demand has dropped and then prices have stagnated from there on. Savills have only predicted growth of between 0 and 1% in the next year, so London still isn't the place to invest because salaries haven't caught up with the wider property market yet. If you have a pot of cash to invest in property, putting it into a property that's only going to give you a 3% yield and no growth moving forward is a waste of the potential of that capital. Let's look at an example. If you bought a property this year in London for 500k with just 1% growth over the next 10 years, you're obviously losing out to inflation, but secondhand that property would only be worth 552k-ish in 10 years time. Meanwhile, if you put that same pot of cash into properties in Manchester, buying 2 properties rather than just the one, if we can look at the forecast by companies like Savills, and if they're somewhere in the right ballpark and Manchester sees 5% growth for the next 10 years, buying 2 properties in Manchester would give you the opportunity to scale a property portfolio to around 815,000. Your equity within the portfolio would be around 440k, and this is without refinancing that property or any of those properties by year 5. If you did do that, however, and decided to refinance your properties in year 5 to release equity and scale the portfolio, your portfolio would be worth significantly more. With this 5% growth for 10 years and refinancing after 5 would give you the opportunity to scale your portfolio to 1.1 million in just 10 years and have the opportunity to then refinance them at the end of year 10 to then scale further. Obviously, this isn't me saying that Manchester or any location will have this much growth in the next 5 to 10 years, but if we can target locations that are forecasted to have good growth, it maximizes our chance of getting good returns moving forward. We use these forecasts to predict what we can grow our portfolio to, and if they're anything to be trusted, and if we look at data that's happened in the past, we might not be a million miles away. For the second area you need to avoid as a property investor looking for long-term growth is actually the opposite of the London market. It's what we call the yields trap. These are locations that often look good on paper because they have strong yields of 8 to 10% for normal buy-to-let properties. They're often locations in the northeast, but they can be places like Blackpool in the northwest that have a lack of capital growth because of the lack of strong fundamentals in that area. Let's take Sunderland in the northeast as an example. On paper, the yields in Sunderland look really strong. You can get a 10% yield on a property worth 90k relatively easily in the local market. But when we look at the 20-year price change in Sunderland from 2006 to now, prices have grown just 22%. The yields for these ones can be okay, but often these properties come with high tenant turnover and high maintenance costs, but That's not a blanket rule for all of those properties. If you are targeting cheaper properties in 2026, you need to be aware of the changes with the Renters' Rights Bill, where management and maintenance are going to be way more under scrutiny. That 10% gross yield can then quickly turn into a smaller and smaller net yield, which means your profit is getting eaten into month on month. For me, this isn't an investment, that's a job. You're giving yourself a second job by buying the wrong type of assets and making your life more stressed than it needs to be. Let me show you the numbers for Sunderland over the last 20 years, and we can work out why it might be a problem. The average property price in Sunderland in 2006 was 106k. The average property price now is around £140,000. Yes, in nominal terms, that is some growth over the last 20 years, but we need to adjust for inflation, and once we do that, we can see the real problem with this. So when you factor in 77% of cumulative inflation over the last 20 years, a property that was bought for 106k would need to be worth £187,000 today just to maintain its value. This means that if we're looking at the average property price in real terms in Sunderland, the average property has dropped by around 24%. While investors here have been busy collecting their 10% yields, other investors targeting growth locations have had the opportunity to scale their portfolio and refinance several times through the growth of those properties. This is why we don't target these areas. And they're not just in the northeast, but they are cheap places that have had a lack of capital growth in the last 10, 15, 20 years. Next up is Brighton and the South Coast. A general rule of thumb that I look at is the Southeast and the South Coast usually follow London. Often they would be popular because they would have people that would live there and commute into London for job opportunities. However, again, when prices get to a point where affordability doesn't reflect the average property price in that area, then prices will start to slow and even drop. Over the last 12 months in areas like Brighton, we've actually seen property prices drop, and the main reason for this is demand isn't there and reflective of the property prices. The average home in Brighton now costs well over 10 times the average household income, which means affordability isn't there for normal residential mortgages. Not only this, properties in this area are sitting on the market for longer, which can create a liquidity trap for property investors. This doesn't mean that you can't do things like flips and projects like buy, refurb, refinance, but you have to be really careful if you're looking to sell the property at the back end and make sure that you've priced in all of that when you're looking at a deal. For me, things like flips and project-based property investment can work anywhere in the country if you know what you're doing. The problem is, if you're doing it in an area like this, you need to make sure that you can be confident that you're going to sell the property quickly, especially if you've used short-term finance like bridging finance. Having said that, we don't do project-based property investment, and most of our clients aren't interested in that because they don't want to give themselves a second job. The fourth and final locations you need to avoid as a property investor looking for growth in 2026 are stagnant towns. This one actually catches out quite a lot more experienced property investors that usually know what they're doing. These locations often include places like Northampton or Leicester. The places aren't crashing, they're not having real big problems, but they're also not growing much either. Unlike other locations like Leeds, Manchester, and places like that, these locations aren't getting institutional spending. This means that they're not improving long term over time, and demand is unlikely to increase dramatically in these locations. When demand doesn't increase, prices are unlikely to increase much as well. If your property is growing at 1%, if that's leveraged, it's not the end of the world, but it's not going to change your life, and it's not going to give you the opportunity to build a portfolio by refinancing every couple of years. Whenever I speak to property investors on a daily basis, a lot of investors look at these locations, especially Northampton, as quite a stable location. It's not too far from London, prices are reasonable, and growth is what they call stable. Stable, in my opinion, is unfortunately just another word for stagnant. If you're not having much growth at all, then what's the point? Yes, you're not really losing money, and it is a way to protect your wealth long term, and if you're based there, then I do see the argument for doing it. However, if you're really focused on building your wealth through property, your best bet is looking at locations that are primed for long-term growth because of having stronger fundamentals and real growth engines behind institutional investment. Obviously, this video is focused on lots of places to avoid as a property investor looking for growth, but it's not all doom and gloom. There's still some great locations you can consider to build your wealth through property. These locations are where the fundamentals are. big institutional investment, strong employment and improving employment, creating further demand for people moving to the area. We're looking for institutions like big universities where students are staying on after they finish their studies, good transport links both locally and nationwide, and most importantly in the current market, strong affordability. You get these ingredients in places like Leeds, Manchester, Liverpool, Sheffield, and cities throughout the Midlands. And if you're serious about building your wealth through property, you need to make sure that you're looking at the data and the granular data to make sure that you're maximising your chance of scaling your property portfolio. So to conclude, investing in 2026 is about avoiding prestige but not targeting the cheapest areas in the market. You need to find a balance between having strong fundamentals and strong affordability to maximise the chance of you building your wealth through property. If you're interested in investing in property in 2026 but you don't have the time to go out and do it yourself, or you want to invest in an area that isn't local to yourself and want to use our knowledge, then I'll put a link to our website called Freighter Property Partners in the description and you can have a free chat with one of the team. But that is everything for today's video, so I hope you've enjoyed it, I hope I've not scared you too much, and I'll see you in the next one.